Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today we are continuing our look at macro because honestly, that's all that seems to matter for the markets. The market is now betting we're going to get a rate cut in December. A couple of weeks ago, the market thought there was no chance of that. So what changed? We're going to speak with Bipan Rai. He's the head of ETFs and Alternatives Strategy at BMO Global Asset Management. He says there is a non-zero chance that the Fed is at risk of making a policy mistake. We're also going to hear why he thinks there's more upside for gold in 2026. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Bipan Rai, thanks so much for joining me.
It's good to be here. Thank you.
I've had the chance to interview you over the course of many years, and you've worn so many different hats. I think of you as kind of a big picture macro guy, and you used to really get in the weeds, trading currencies, really being active. Now you've got this role, you're head of ETF and Alternative Strategy at BMO Global Asset Management. I imagine that's like less in the weeds of daily return and more like 30,000 feet thinking. Is that the right way to think about it?
Exactly. I mean, there's nice dovetails between what I used to do at my prior job, meaning that I'm more focused on the macro economy, what's happening from a big picture perspective. It's just now that instead of talking about currencies and interest rates, it's really about the broad shelf of ETF and alternative funds that we have at our shop.
Okay, but let's talk about currencies and interest rates.
Okay, fair enough. Yeah.
Because I know you can do it. And right now, that is the market's current obsession, is about interest rates, particularly in the United States. Like November has just been ugly for the stock market. Mm-hmm. And then it's starting to perk up because the odds of a rate cut by the Federal Reserve in December went from like 30% now to better than 80%.
Right.
With really no major data point so help us understand why there has been this sudden enthusiasm for pricing in a rate cut.
It's a good question and a very, very relevant one at this point, right? Because if you give me the guts of what's happening in the U.S. economy right now, right? So we've got Q3 growth tracking close to 4%. I mean, if you average the last 4 quarters, we're north of 2%, right? So that's still above what we call the potential output for the U.S. economy, which I kind of look at as around 1.8 to 1.9%. So still getting healthy growth. Now, you can argue that a lot of that is engendered by AI spending or CapEx on AI, but there's a good chunk still being driven by household consumption, which of course we could dovetail into the AI story as well, but we'll leave that for now. We'll park that aside. So you're still getting decent growth. You still have inflation running closer to 3% than the Fed's target, which is 2%, right? So I'm talking about headline CPI, also about PCE. If you're giving me those two sort of, let's call them narratives, and I'm like, at this point, it doesn't really make sense for the Fed to ease rates at this point. But then, we dovetail that with what's going on in the labor sector, right? So, of course, the last couple of non-farm prints that we've received prior to the shutdown, seem to indicate that there was a degree of slack building in the U.S. labor sector. The unemployment rate has been moving up. But if we look at some of the more frequent pulse checks for labor sector in the United States, I'm talking about initial jobless claims, continuing jobless claims, they're telling a bit of a different story there. We're not really seeing a meaningful pickup or even, a pickup to the level that we've seen in prior slowdowns and recessions. So, if this was 2018 and 2019, Amber, I mean, I'd look at the body of evidence and say, it's a no-brainer. This should probably stay on hold at the December meeting. But of course, we're in 2025, which means we also have to think about things from a political lens. And I think that's part of what we're seeing play out.
People never said that overtly, right? And it took them a long time. I think actually you're the first person to say that overtly right. In 2025. We know that because President Trump has been overtly calling for lower rates. But there is supposed to be this separation between church and state. And it sounds like you've just come around to the fact that that's no longer, religion in the U.S. And you have to think about it that way as a strategist.
You kind of have to factor it in, right? So there is this sort of understanding that, yes, the Fed chair, it's one vote, right? I mean, it's one vote out of 12. Doesn't really dictate what the Federal Reserve is actually going to end up doing, whether they're going to hike or cut. And it's certainly within the realm of possibility that the Fed chair can be outvoted by everybody else. But, the problem is now that we've got, an activist White House that's trying to remove certain Fed board members. And that's something that, people in my position have never really had to contend with or really have to think about when we're forecasting what's going to happen with respect to the Federal Reserve. And, if that's becoming more and more of a clear and present risk, then I think it leans into the possibility of a miscalculation when it comes to actually implementing policy, right? So if we're looking at 3% by the end of next year, again, potentially that could happen, but it doesn't mean that it might not be a policy mistake.
I think that's important to underline because the markets just are like, whatever, Bipan. We want a rate cut. Whatever, Bipan. We want a rate cut. We're going to get this rate cut, and equity markets can rally. But how do you think about the risk of this? It being a miscalculation. And what do you do about that in your portfolio when the markets so clearly are like, yay, rate cuts, let's do this.
Right. So there's ways you can get around it. I mean, certainly if we're getting closer and closer to a policy misstep, I mean, to me, that engenders potentially, an environment of higher than normal inflation over the medium to long term. And that will have implications, I think, more so for the fixed income sleeve of a portfolio. So maybe shortening duration on that leg would be one consideration. For equities,
duration meaning just don't have as high interest rate exposure,
or further out the curve, right? So instead of say a 5 to 10 year or 10 to 10 year plus bond, maybe shortening that to 2 to 5 year, right, for a particular sector. Equities is a bit less clear how they react to high inflationary periods. I mean, then we're really getting into the weeds of which sector we want to be allocated to. But, if you're leaning into this possibility, let's say that the Fed is making a policy misstep, then maybe positioning for something that is akin to being a little bit more defensive, say healthcare or staples, both of which sectors have done reasonably well over the last little while. I mean, that's prudent, I think.
Is this your base case that it is a policy misstep?
I don't want to say that at this point, just because, look, we don't know what's going to happen on December or even in January for that matter, right? So, there is that school of thinking that if they cut in December, they'll probably eschew a cut in January. But I want to see what the data tells us. We are getting a deluge of backloaded data over the last couple of months, particularly in the labor sector. I want to see if let's say the November non-farm print is a little bit firmer than expected, or if the unemployment rate stabilizes here. Right. If that is the case, then maybe they're not, necessarily, maybe they'll look at potentially standing pat instead of easing. Right. So that's something I want to look at first before I deliberate.
So you're talking about growth running above potential in the U.S., inflation pressures still not calmed down. Yes, labor market is a bit of a question mark, but we still don't have a perfect sight line into what that looks like in real time, and the risk of the Fed making a policy mistake. I think it's interesting that you said you've never seen a Fed under pressure like this from the government probably since the 70s, and we know what happened then with inflation, but also chaos within the Fed.
Yeah.
I can't remember a time where we've had somebody calling for a 50 basis point rate cut and then somebody else saying, actually, I think we should hold. Those are two different countries that those Fed members are living in.
Right. And you could argue that it's probably good from the point of view that you won't get, as many Fed members moving in the same direction. You get that diversity of thought for sure. I always think there's value in that. But, there is also an element of, one of the members who is calling for a 50 basis point cut, board members has been appointed there by a president who has been so, let's call it interventionalist when it comes to his views on what the Fed should do, to a degree that we hadn't seen with prior presidents. And I think that is, a long-term market risk. And usually, we tend to see these sort of periods pop up whenever inflation is higher than normal, right? Because again, if really when it comes to being elected, I care more about the unemployment rate if I'm a U.S. president. So naturally, my inclination is going to be argue for lower interest rates and make sure the economy is operating at close to full capacity so that the unemployment rate moves lower. It's, inflation tends to be more of a slower moving, let's call it headwind in that sort of environment for a president.
I also think you talked about this data dump that we're getting. The data dump is from September, which was that was before the shutdown. Do we know? Are we going to get October data? Mm-hmm. Are we going to get a release for November jobs data? Like I don't right now see that on the calendar. I could be missing it. It could come in later, but that's like a big chunk of data that's missing before an interest rate decision.
Yeah, and that's what makes this particular decision very, very tricky, right? So, if we're talking about October data, I don't believe we're going to get the CPI data. I think the BLS has already come out and made that announcement. The November data is going to be, I don't want to say contaminated, but again, the usual data collection methods will have been not interfered with, but it'll be different this time around.
Distorted from the shutdown.
Distorted from the shutdown is a good way of saying it.
And maybe it's not real. Like, what are these jobs numbers anyways? Look at the revisions. I just feel like, have you ever had less confidence in the data that you're supposed to be using to forecast the situation?
Well, guys like me have to work with the data we're given anyway, but you're right. Response rates to surveys have gone lower over the years, progressively, right? So there is something that does need to change insofar as data collection goes. But if we're talking about November data, that's going to be, you kind of use that with the mosaic approach with some of the other private sector data that we're getting by ADP and also, what the backloaded initial claims and jobless or initial and continuing jobless claims have been telling us. And then you kind of put together a picture of what you think the labor sector looks like. And I think that's what the Fed is going to do.
Also you could look at profits. Like the market is rallying because the earnings season we just came through was tremendous.
Yes.
It was a success. It wasn't just clearing a low bar.
Right.
There was real earnings growth, the best that we've seen in years. Mm-hmm. That must bring some comfort as well.
I think so. If we look at the story of S&P 500 returns for this year, a lot of it has just been, most of it has been driven by earnings as opposed to multiples expansion, right? Whereas, it was quite different in 2023 and 2024. And so you do have the guts of a healthy fundamental backdrop in the United States, right? So again, a large number of people are going to be like, well, it's driven by AI, right? This is all just AI and all that is circular. So how do we know this is actually real? Well, that's a good case. That's something, certainly we'll pay attention to, but that doesn't necessarily mean it can't continue on into 2026 at this point.
I was speaking with somebody yesterday who said, the best strategy, and I'm going to say this as somebody who has a finance podcast, was to put on noise canceling headphones, ignore tariffs, ignore everything, and just stay invested because there were a lot of different headlines that could scare you out of the markets.
Yep.
And so, was earnings the North Star, the thing that was the only thing that mattered this year?
Yeah.
Was that we're still getting earnings growth?
Yes.
Is that how we should think about why were the markets so resilient?
Absolutely. For me, it's always going to come down to, if we're talking about broader markets and whether or not a drawdown is going to be sustained over a long period of time, where's the Fed setting policy, right? Are we at restrictive settings relative to what neutral should be? If so, then I get a little bit nervous about whether or not a drawdown is going to be sustained. That to me tends to have more real world impacts. I tend not to pay too much about, say, a conflict in the Middle East, which is something that we came fairly close to earlier this year. Mm-hmm. Tariffs are an exogenous shock and they do matter, but guess what? Markets will adapt. Firms will adapt, right? And this is going to be something that is more slower burning. But, it also brings to light some of the other imbalances that we've seen in prior years, right? I was of the opinion of the last couple of years that maybe markets were too overinvested in the United States. And certainly we've seen a reallocation out of the United States and into the international market. So, it does make sense to stay invested, but it also makes sense to, understand where the imbalances are and adjust accordingly.
Do you think that, some of these markets, like the Spanish market's up 40% so far, and the German markets have done well. They're up 20%, which is better than the S&P 500 in 2025. And then here we are, Canada. This has been our year. We're up 26% so far in 2025. Part of that is gold, which we'll touch on as well. But just this vibe of like international outperforming the US, which by the way, over the last 13, 15 years, that doesn't happen. No. The US outperforms all the time.
Right.
So what is this? Is just this like a little bit of mean reversion, or do you think it's the start of something new?
I think it's a bit of both, right? I mean, if it's the start of something new, then I think we'll see more of a bifurcation of that story, right? And it really comes down to who's spending from a top-down fiscal point of view, because that's something that we haven't seen outside of North America for quite some time, right? And particularly in places like Europe, especially in places like Germany, right? So if you're telling me that the German government is all of a sudden, loosening fiscal policy to spend on upgrading aging infrastructure, then yeah, this could be something that's a little bit more sustained, because we do know that infrastructure investment takes longer periods of time, and they do result in cash flows that tend to be inelastic and dependent on, well, I should say inelastic demand, right? So that's something that, if I'm looking to allocate as an investor, that's going to appeal to somebody like me. Right. So, and we also know that a lot of governments are spending on a defense point of view. Of course, that's been part of the whole, increasing spending to get up to speed with where NAFTA says we should be, 2% of GDP. That's obviously been updated towards 5%. I mean, that tells me that there's going to be, more of opportunities, I want to say, outside of North America than maybe in the United States. But having said that, though, we shouldn't necessarily neglect the United States. I think, if you're looking to allocate outside of your home country, the most of it is still going to be in the U.S. for sure.
And nobody else has the AI power
exactly.
that the U.S. has. So I want to ask you about AI, and I'm not going to ask you to make a call on a bubble or not bubble, because I don't know that that's as useful for investors than understanding how exposed should I be to this sector, and in what ways might I be exposed and not realize it, right? I think if you're buying the S&P 500, that's basically an AI index now, right? 40, 50%, you can get to 50% AI exposure in the S&P 500. So should you be as much as 50% in your portfolio, exposed to AI? How do you manage that just from an asset allocation perspective?
So, if I think about AI and the amount of spending that's gone into it and playing that as a theme, I think it's mostly been a beta theme. Oh, your company's spending on AI? Great. You should participate in the same type of returns that we're seeing in other firms, right? But I think it's going to become more and more bifurcated. And the reason why I'm saying that is because, again, up until September, really a lot of the CapEx that was done was from endogenous cash flows, from, say, your operating cash flow. You take that, you reinvest it into spending on, say, building out a data center if you're a hyperscaler. More and more now, we're starting to see that, that's not sustainable. And especially if we're going to see this ramp up in spending on AI, a lot of it is going to be financed by external debt, right? Some of it's going to be off balance sheet as well. But, at the margin, what it tells us is that all of a sudden, whether or not you want to call it a bubble, the fact that we're relying on external financing brings it into sharper relief with prior periods of crisis that we've had before. And I think that's scared the market to a degree. And, going forward, then we have to look at what the existing capital structure is for a lot of these tech firms. And that tells me that there are going to be winners and losers. And guess what? Over the medium to long term, that's actually a healthy thing, right? So I think it's going to change from a beta theme to something that might be a little bit more of, say, an active theme, right? I think Oracle, I know you don't talk specific stocks, but I think Oracle is an example of what you're talking about. Yep. Big AI growth, record backlog, and yet the stock is down 30%, in part because how are they getting that growth? They've got debt, and they've got big exposure to OpenAI. Yep. And OpenAI is losing money. So, there's customer risk there. Is OpenAI going to be able to pay Oracle? And so I almost wonder if the fact that stock is down, that Oracle is down, is a sign of health. Yeah. Right? Would it be worse if Oracle was up despite these issues? Right. It would tell us that the market might be a little bit more dislocated relative to the long-term fundamentals than is usual, right? So the fact that, that the stock you mentioned is trading a little bit defensively relative to its peers, to me tells me that we're migrating from that beta play to more of an activist play when it comes to AI. And certainly that can continue to 2026. But, if you look at the scale of debt that's been taken on by a lot of these firms, and keep in mind that Mag 7 plus Oracle, these, for the most part, we can classify them as, well, actually more so Mag 7, as having fortress type balance sheets, right? So they can take on that debt and they can continue to spend. And guess what? That can still be a good thing for the market and for the broader economy. And I think that's still a theme that's here to stay at least until the middle to late part of 2026. The US has the Mag, the TSX has got the glam of gold. Right. And that's really been key to our success.
not the only thing. Like our tech sector is up 25%, so that's been great. But when you compare that to the materials sector, in 2025 is up 86%.
Yeah.
That is a record annual gain.
Yep.
It's never been as good
Right.
as that. And yet gold is kind of consolidating recently. So, we'll talk about what it's been like for 2025, but I'd love to just get your hot take on gold kind of treading water
Right.
at these record highs. And what do you think that's a signal of?
Well, we're treading at record highs. I mean, we've had a pretty good year for gold already, and certainly you can make the case that some investors are a little bit reticent about adding to gold at these levels. Maybe they're waiting for that pullback, but the narratives are there, right? Like gold is a long-term inflation hedge. I mean, that's not going to go away. I mean, it's also an effective portfolio hedge as well, especially during periods where you have inflation at these levels. Those typically correspond to periods where stocks and bonds tend to be more correlated. So you need a better diversifier than bonds, and gold has filled that void. And so, I mean, I think that's part of it. The other part of it obviously is, again, spinning into narratives. And I'm not a big fan of narratives, and we'll get into a little bit, hopefully, of the supply demand dynamics of gold. But, there is that element of you have central banks that want to diversify away from the U.S. dollar. And that's been played up a lot in the media. And
you don't like that theory?
No, I do like it, but I think we should put it in context, right? So, okay, so if I think about gold from a demand perspective, there's really four sources I'm thinking about, okay? I'm thinking about jewelry demand, right? So that accounts for, let's say, 50% of demand in a typical year. 50% is a big number. If I'm thinking about central banks, that's usually around 10%, believe it or not. Right. So the balance, let's say 30%, come from retail and institutional investors. Right. And then after that, actually, you could say there's a residual that goes into technology and industrial applications and the like. But that's the way that I tend to look at it. And so, if we look at what gold has done this year, let's break it down from a flows perspective. Right. So you could argue that central banks have been sort of allocating a little bit more of their portfolio towards gold. But look at ETF flows. Those have been increasing. Right, total known ETF holdings of gold have been going higher, whereas in the past couple of years they were declining. Right, so that tells me that retail and institutional investors have been the ones driving the bus in this recent gold rally. Right, so prior years you could make the argument that it was central banks mostly.
So they're doing it because they heard the central bankers were buying.
Right, so there's a FOMO element to it for sure.
But is that a risk then?
Could be, because then we have to then look at the supply side, right? So what typically happens after a fairly decent year in terms of price action for gold? Well, we tend to see supply increase. It's not from increased mining activity. It's from recycled gold that re-enters the market, right? So, oh my God, I've got all this gold hanging out at home and I could monetize this? Absolutely, right? And that's when
it can affect supply?
Oh yeah, that's usually around 30% of supply, according to the World Gold Council, right?
Holy moly.
And we're talking about globally, right? So, I mean, it does make sense if you think about like jewelry demand being the top sort of driver of demand in a typical year. On the other side of it, we tend to see more and more recycled gold enter in whenever we see price spikes. Whereas jewelry demand actually tends to ebb a little bit when we see prices increase.
So it sounds like, are you a little cautious on gold here?
I don't think we're going to have the same type of year we had this year. I mean, this was a banner.
Not another record year.
No. I mean, so okay, let's talk a little bit more about supply. So I mentioned mining. Mining accounts for 70%. Jewelry, recycled gold counts for 30%, let's say. Right? So in a typical year, gold supply is increasing by, let's say, 1% to 2%. Okay? And, unlike fiat money and the like, we can say with a fair degree of certainty that we know all of the available gold that has ever been mined is close to, say, 220,000 tons. Okay? But demand usually does increase by more than 2%, right? Which is why there tends to be these sorts of moves in gold. And, if, let's say supply increased by 2% this year, I can tell you that out of those four categories that I mentioned earlier, demand increased by close to 10%. Right? So again, excess demand relative to supply, that only means one thing for a price, usually.
So does that mean that maybe, there's a lot of ways to play gold, and we're going to talk about this in your pro picks, but then I almost think if gold isn't going to have the kind of rally that it's had over the last couple of years, but if it stays at these prices, that's still a lovely time for the gold miners.
For sure.
And so is the play maybe the gold miners over bullion?
Yeah, I mean, it could. We did see a fair degree of miners.
Yeah, they've done.
Miners basically crushed it this year relative to bullion. And I don't want to say that that next year won't be a good year or a positive year for gold. I certainly don't feel that way. I do think that we are going to see a degree of let's call it outperformance when it comes to gold. I just don't think we're going to have the same type of year we had this year. Now, can gold get to say 4,500 by the middle part of next year? Absolutely. In fact, that's our base case call for what we're expecting. Right?
What's the price?
4,500 by the middle part of next year.
Okay, so we're at 4,100. So still,
still positive, right? So there are ways to play that still, and I still think that there is value in having gold in your portfolio, right?
And I get that investor demand increased, but some people who are gold bulls will come on the show and say it's still so low as a percent. Like, is it still so low as a percent?
It's tough to say, to be honest with you, Amber. I mean, remember, gold is a wonderful sort of diversification instrument, right? But for the most part, and again, we're going to touch on this a little bit later, I mean, it just sits there. It doesn't earn yield, right? And I think that's sort of been the knock against gold for a long period of time. Now, we have this wonderful ETF that we've crafted that basically takes advantage of the fact that gold volatility tends to spike when market uncertainty spikes as well. Right. And so what we did is we crafted a covered call strategy around that. And so guess what? You do get participation in gold prices moving higher. But at the same time, you also do earn yield as well.
Yeah.
Right. So that's our gold covered call spread idea, which is ZWGD, which is something that we came to market with this year and we're quite proud of.
We're going to talk about that in Pro Picks. But I wonder, too, if the obsession with gold, yes, gold prices are moving higher, but generally, if I look at the Bloomberg Commodity Index, commodities in general have been moving higher.
Yep.
And, some people will say it's really simple. If the U.S. dollar is under pressure, you're going to have a positive environment for commodities in general. People are still waiting for that to show up in crude. But, other things are doing just fine.
Right.
And so I guess I wonder, aside from gold, but just how do you think about that interplay between the U.S. dollar and just commodities in general doing better?
Yeah.
Especially since you are concerned about inflation.
Sure.
Inflation does well for commodities.
Yep.
And, all this infrastructure spending, they're going to need these metals and things like that.
Yeah, absolutely. And you just laid out a perfectly excellent bull case scenario for commodities going forward, right? So, a bit of, the rationale for why gold outperformed this year is this whole concept of de-dollarization, right? So that's the central banks moving away from dollars, but it's also the debasement to a degree of the dollar, right? So, whenever you have, let's say, I don't know if anybody carries cash anymore in their pockets, but let's say you pull out a $20 bill. At the bottom left, you're going to see, usually there's a signature, right? Who's that signature of, right? In Canada, it's the Bank of Canada's governor and the senior deputy governor, right? So that, I don't think people understand that one of the Bank of Canada's roles, and to a degree also the Federal Reserve, is to preserve the integrity of fiat currency, right? But there are times when that goal comes into tension with the inflation mandate, right? So we target 2% inflation, right? We've been targeting 2% inflation here in Canada since the early 1990s, right? So, you compound that over time. I mean, naturally, what you're going to have is an environment where your fiat currency does lose nominal value, right? And there'll be times where that is accelerated, right? Especially if you have an exogenous shock like tariffs, right? What do you do in those sorts of instances, right? You go after assets that tend to be relatively fixed relative to other assets, right? So especially since the financial crisis, where we did see central banks resort to, extraordinary measures like quantitative easing, right? That did increase the supply of, or the money in, the money supply, I should say. I mean, it increased the type of money that you and I don't transact in, banking system reserves, but nonetheless, that does matter for the psychology of the market. Right. So whenever that happens, you want to own fixed assets. Right. And if we're talking about inflation, having something that's fixed increases in value as well.
So that's more positive for gold over owning U.S. dollars.
Yes, exactly. Right. So, I mean, just overlay a chart of gold over the past 2 decades against the S&P 500. You'll know what I'm talking about. Right. Sometimes the denominator, what we value the asset in, matters a lot more than the numerator. And I think in a lot of cases that's
And
true.
if we looked at that chart, what would we see?
We would see gold outperform the S&P 500 over the past
Because
2
of the
decades.
last 2 years.
No. Yeah, I mean, there's been periods even, I want to say, towards the early 2010s where that was the case as well, right? So if you price the S&P 500, instead
gold
of
terms.
in gold terms, you're basically flat, or you're sort of flat-ish, I want to say.
And we haven't brought up the Bank of Canada in this discussion, mainly because they're just done. So, right? They just said we're done. And so now it's over to you.
Yeah.
Is that like, do we need to spend more time on that? Or is that basically
How much time do you got?
You tell me, can I gloss over the Bank of Canada, or is there something spicy there?
I mean, there's always going to be something to talk about with respect to the bank, unfortunately. No, I shouldn't say unfortunately, because I do like talking about the Bank of Canada.
Yes.
So here's the problem, right? We've had this accelerated easing cycle basically since June of last year. And, obviously there was a good reason to start that cycle and to accelerate it. We've got, this huge mortgage debt, mortgage refinancing cliff that's coming up over the next couple of years, predominantly in 2026 now. So, the Bank of Canada got ahead of the curve and did a great job of that. It did not do this because they had anticipated that tariffs were coming and what that could mean for the Canadian economy, but it actually did dovetail nicely with what ended up happening. And the other thing that's really difficult for a guy like me to project is what's going to happen with USMCA, right? Because don't forget, a lot of the goods that we're still exporting to the United States aren't tariffed because they qualify under USMCA, right? So it's really a function of how fast businesses can fill out their paperwork, right? Now, we know that the USMCA is going to sunset in 2026, which means we're going to have a renegotiation period between the US and Canada. Now, my job is to look at the market, project what the market's going to do based on the economy and other macro factors. The one thing I cannot do is project what a politician is going to think and say. And that is, that's a troubling spot for all of us in this community. But, based on the available data that we have, is the Bank of Canada done? I can say yes. But what happens with the USMCA is something that I'm looking at as a huge question mark next year. Because if the USMCA is done away with, then all of a sudden we're back talking about recession risks, and we're talking about the Bank of Canada taking policy rates even lower.
But they have room.
They're
not at zero.
No, they're not.
They're 2.25, right? 2.25.
Yeah.
So they would have the room to do that.
Yeah, they do. And even if they were at zero, we saw it from the pandemic days or other measures they can take, including long-term or large-scale asset purchases.
For now, though, it does seem like we're over to the federal government to solve some of these problems. We're about a month away from the last federal budget, or a month out, I should say, from the last federal budget. And we saw a lot of spending and no path to black. But the question is, what are we going to get as a result of that? And some of it was, kind of pro-business. It's looking at accelerating certain projects that are in the national interest and supporting areas that have been hurt because of the government. And we're going to probably get more details about that this week. Sorry, not because of the government, because of tariffs. Supporting areas that have been hurt because of tariffs.
Right.
I don't know what that was. Yeah, the Freudian slip. I don't know. No, because, a government, just not ours, the U.S. government. Right. So how do you think about that, with your economist head, and how effective it could be?
So, the interplay between fiscal and monetary policy is always going to be important to understand for somebody like me, right? So, typically if you see the federal government, in sort of this expansionary mode, that to me would tell me that growth projections should probably be revised higher. And then, I would dovetail that with what is happening at the monetary policy level. And if, the central bank is easing rates, then all of a sudden you've got this environment where the growth projections should probably be revised higher. Now, with this particular budget, this was easily the most substantial or substantive budget we've had in years, and probably the most important one. And, a lot of it we had known going into it. We knew that, the largest line item was probably going to be the middle class tax cut, and that's what ended up happening. We knew there was going to be heavy focus on infrastructure and also on house building and the like. And, that to me tells me that, if I look at the forward projections, for the Canadian economy, and certainly for in this sort of expansionist phase, then, if the USMCA stays as is, based on the available data that we have, I mean, it really does make sense, for the Bank of Canada at this point to stand pat. And maybe, a couple of months from now, if we are seeing growth pick up and inflation maybe stabilize and move higher, the next move might even be a hike from the Bank of Canada. Right, as insane as it might be to say that now, but that's sort of the way that I would look at this, right? Because we are going to potentially, hopefully, get that growth surge that does help this country deal with this with the trade shock that we're going through.
Unless USMCA falls apart or these mortgage renewals are more intense than the banks had been preparing for.
All right. I think the former risk is probably more acute than the latter risk. I think the latter risk has been well understood and absorbed for the last couple of years, right?
I'll just explain that in case you don't know what that means. It's basically everybody and their mother, including myself, probably took a mortgage in 2020, 2021 because rates were so low. And so even rates moved up, obviously, in 2022. And so when you renew, because they often renew in 5 years, you're going to be faced with higher payments.
Exactly.
And even though we've had rate cuts, they'll still be higher than zero.
Right.
So that's kind of the cliff. But to your point, we've known this for years and years and years. So in a perfect world, banks have already dealt with this.
Banks have dealt with it. And that's one of the reasons why we think there's been so much inflow, speaking of ETFs, into money market funds. We think a lot of households have been parking liquidity in shorter term instruments that offer yield in anticipation of the fact that, in 2026 onwards, that their household outlays, insofar as mortgage payments are concerned, are going to increase. Right. So we think that households and banks have done enough to deal with the upcoming risk that we have, I guess, revised that risk rating lower from high to say something akin to low to moderate at this point.
Okay, so we've talked about places to be defensive, places for income, and infrastructure optionality. And you've brought us 3 ETFs that kind of focus on that. So let's get into those ideas. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so the first one, we've talked about gold. So you've just got a way to own gold, which is the bullion ETF, ZGLD. Talk to me about, I guess, the case for owning in a consolidation phase,
right?
And to what have you seen in terms of the flows, right? This is one of a BMO product that you guys have, but you must also get a lens into demand. Because of interest in this ETF over the last couple of years. Yeah,
absolutely. I mean, I think the demand has been driven by, again, the need for that hedge when it comes to potentially inflation risk as we move into 2026 and 2027. Again, if we're talking about extra government spending, if we're talking about potentially, the I don't want to say the debasement of the domestic currency, but I do think that's becoming more and more of a risk. If we're talking about the balkanization of trade, then we need to think about inflation and hedging against that inflation risk over the medium to long term. And gold has proven time and time again to be that instrument that can provide that hedge. The other angle of it also is the fact that, if you're a believer in this theme that central banks are going to continue to diversify away from the US dollar, then certainly it makes sense to have that exposure to gold within the portfolio. We think these themes are structural. They probably have another year before we're ready to say that the narrative or the jig is probably up on the trade. But if that's the case, then, you want this sort of instrument in the alternative sleeve within a portfolio to offer that diversification that you probably won't get from fixed income going forward.
So you mentioned in a period, though, where you're kind of just waiting on gold to decide what its next move is.
Yep.
And you do see it going higher to 4,500, maybe not the percent gains that we saw in the last year. You do have a covered call ETF on gold bullion.
Right.
So explain how this works. And this is newer.
Yes, this is new. So this is a covered call spread. So it's different than a covered call strategy, right? Where we're writing a call option on the underlying. This time we're writing
I want to pause there because a covered call strategy on something like this would be basically giving you income, mitigating your downside, but limiting your upside.
Exactly.
And so this is different. Tell me how.
This is different because we're also buying back the further out of the money strike, right? So we're selling a call spread, right? So that means that we are generating income because we are selling the structure itself. But at a certain point, we will start participating in topside gain again, right? So it gives you that upside exposure to gold while at the same time harvesting some income as well.
What does it do for your downside protection, though? Does it leave you more exposed? It's the same. As if you were just having a covered call.
As if you were just having a exposure to gold.
Gold. Okay, it doesn't make it worse to the downside. What kind of yield are we talking about?
So the yield typically, it's close to 5%, right? So it's still fairly attractive on an annualized basis. And again, this is something that we've come up with that really does address the long-term problem of having gold and the fact that you don't really earn a yield once you do have allocation towards it. So this is something nifty that, we've come up with to address that concern. And something that also does help with the fact, or at least take advantage of the fact that volatility in gold, when it rises, gold typically rises as well. So,
I'm not the smartest person on options, but I do know that some criticism people will bring up about covered call ETFs is like how actively managed that process is, and like, are you being opportunistic with your timing, or is it just kind of robotic call writing? Explain to me how that. A, why is that important? And B, how that happens in this ETF.
Right. So, this is probably something that a portfolio manager that manages the fund would be able to explain better than I would. But ideally, you don't want something like this to be automatic and robotic, right? Because there's so many different legs to how an option trades, if we're talking about the Greeks. And managing that takes a more activist approach than relying on something that's a little bit more passive.
So this is active.
This is when it comes to the background of managing the strikes and how far the money they are, there's an element of that too.
Okay. Yeah. You mentioned, we talked about the stimulus that is coming out of governments really around the world.
Yep.
But in Canada, you called our federal budget maybe the most consequential, certainly in the last 10 years. And part of that is because of all the spending.
Yep.
And so you would play that. Well, Canadian, but this is a global infrastructure fund, the BMO Global Infrastructure Fund ETF. So what is the play? Is that a global fiscal stimulus play?
Yes, it is. Very good way. You basically pitched it for me. But again, if we're talking about moving away from the trade system that we've all been used to, free trade and everyone having low tariffs, low barrier access to each other's countries, that's been a huge growth driver for a lot of developed market economies, including here in Canada. And if we're migrating away from that system, guess what? We're going to need another source of growth to plug in to offset that. And that's why a lot of governments are turning towards spending, right? And, we've seen it time and time again. How many times have we flipped on the news and we've seen reports of, say, a power outage somewhere? Or, earlier this year, I remember this because I was supposed to travel to London. There was an outage at Heathrow Airport, right? That is a signal of aging infrastructure, right? And that's not just a story about Heathrow Airport. We've got that problem all over the developed world. It's a huge opportunity for growth and for spending, right? And the advantage of being invested via infrastructure, and I spoke about this earlier, is that you're gaining access to funds. And the underlying is really, investing in say an asset that is dependent on inelastic demand and basically monopolistic when it comes to sources of revenues for the most part. Right. And I think is something that should appeal to a lot of investors. And infrastructure, this particular fund has done fairly well this year. And, this is a space, within the alt sleeve that we want to remain invested in for several years from here.
And this, you mentioned it's global, but you'll get nice exposure to Canadian companies.
Yes.
Enbridge, TC Energy are some of the top holdings. In the U.S., you have American Tower, Williams and Company. So big kind of pipeline exposure, electrification exposure, and then some real estate as well. And even though you have those Canadian companies, looks like 70% exposure to the United States. Okay, interesting. Thank you so much, Bipan. Thanks for bringing these ideas to us.
No, thank you for having me. This has been a treat for me.
And for me too. Thank you so much. That's Bipan Rai joining me at BMO Global Asset Management. Don't miss our next episode. We've got Shiraz Ahmed joining us. He is a fund manager with Sartorial Wealth Management. He can take your questions on North American and global equities. If you want to hit us up and have your questions answered by a professional, you can email us at questions@inthemoneypod.com, and we'll see you on the next episode.